Okay, good evening, everyone. My name is Stavros Yanuka. I'm the Executive Vice Dean of the Kuan School of Public Policy, and it is my pleasure to welcome you to a public seminar to be given by our distinguished guest, Simon Ogus. Simon is the founder and CEO of DSGAsia Limited. It's an independent consultancy based in Hong Kong. It offers analysis of the economics and politics of Asia. Simon works with a variety of multinational and regional entities in the financial, non-financial, and governmental spheres. Now, Simon's background is in banking. He was managing director and chief economist for Asia at the Swiss Bank Corporation, which subsequently became SBC Warburg and subsequently merged into UBS, the Swiss banking giant. He also held a position as an adjunct professor of finance, economics and finance at the City University of Hong Kong. Now, Simon still serves on the board of a number of companies and official bodies, including the Council of Advisors of the Hong Kong Monetary Authority and the Hong Kong Institute for Monetary Research. Or actually, it's the Hong Kong Monetary Authority's Hong Kong Institute for Monetary Research. Interesting name for the institute. So Simon's a trained actuary, which means he's actually quite smart and numerate. He got his PhD in economics from the University of London's School of Oriental and African Studies. Now, I thought his the title of his talk is very interesting: China and India's Rise, the America of the 19th Century. I imagine we'll be hearing about parallels between the current growth of China and India and what happened in the United States in the 19th century. So with that, welcome Simon, and welcome everybody.
Very much, Stavros. And thank you also, Astrid, for putting this together. She's been bugging me ever since she showed up in Singapore to come down. So I hope I'm not going to disappoint her too badly, or yourselves for coming along. It's also nice as a Hong Konger to be able to say that the air is actually crappier in Singapore than it is in Hong Kong today. So we have to thank our Indonesian friends across the border, I suspect, for that one. Appreciate you not mentioning the criminal record in the bio. Thanks very much. Although I earn a somewhat shoddy living, largely dealing with financial institutions, because they're the ones who've got your money. I'm actually, my academic background has always been in economic history. So the problem is, until Niall Ferguson came along, you couldn't get paid as an economic historian. So maybe that's going to change, and I can sort of give up on this financial markets rubbish. But basically, my doctoral thesis at SOAS was on ancient Chinese economic structures and thought. And I'm a great believer that when you look at even modern economic analysis, you should not look at the last 5 years' worth of data and extrapolate from that, but you should be looking at decades, if not centuries, of data. So what I'm going to do today is take you through one of my big investment theses of the last decade and show you lots of funky charts going back. I think the best one goes back 16 centuries, so it's going to be a nice ride for us all, I think. I hope you can see these. Santayana, those who forget history are condemned to repeat it. There is nothing new in the world today. Many of the things we're seeing today are things we've seen time and time and time again. It's just that we have a remarkable ability to forget that these happened before. I've got three little charts, or three little snippets here. The first is, if you look at the quote at the bottom, this is one of my favorite quotes from China, because it shows that intellectual property right violation has a long and glorious history. You can see that this is from a Spanish missionary who was knocking around in China in the late 1600s. basically complaining that imports of manufacturers from the UK and from other parts in Europe were basically being copied and sold up country as genuines not too long after. The second is, and I'm going to talk about this a lot more, is that people have got very excited about the China story, the India story many times in the past, and this is a cartoon from 1900, shows that you've got, it's difficult to see, but basically you've got Germany, you've got Russia, you've got Britain, you've got Japan, all wanting a piece of China. And third is a chart taken from the recently late lamented Angus Maddison, who's, if you haven't read his book, The Millennial Perspective, World Economy, it's a tremendous read. Some beautiful, beautiful data series in there. But it just shows you that really the blue line, Western Europe, we were a bunch of hairy backs until about 1300. It wasn't called the Dark Ages for nothing. And China and India, especially China and indeed the Arab world, were until about 1300 or so way, way ahead of the West. And I'm not talking about GDP. I mean, there was a great deal of excitement the other week when China finally surpassed Japan as the second biggest economy in the world. Well, quite frankly, that's the law of large numbers. If you've got 1.3 billion people and they don't earn very much, it's still a big GDP number. I mean, India is going to surpass China in the next few years simply because of demographics. The important thing is really per capita GDP. And what you can see is that basically China, from around about 1300, the Arab world, they went backwards in relative terms, just as the West was getting out of the Dark Ages and we had the Enlightenment, the Reformation, and then a couple of centuries later kicked off the Industrial Revolution. And you can see that in recent times we've had a bit of catch-up on that. So with China and India now basically reintegrating with the global economy, I'd like to take you through some of the themes which I think lend this rise to being very much more like a process that we have not seen since the late 1800s. Because despite the stellar performance of Japan and Korea and Singapore and Malaysia and all the East Asian countries since the end of the Pacific War, the reality is none of them were really big enough in global terms to make a huge difference. Yeah, it wasn't great if you worked in the US semiconductor industry, but the reality was that these were really quite minor changes. However, if you think about the period from 1867 onwards, this was a time when three new huge economies proportionally hit the global economy. So in the case of America, the Americans have basically been too busy fighting with themselves to really become an industrial nation. It wasn't until 1867 when the North won that we started to see America suddenly becoming a huge industrial power. At the same time, or within about 4 or 5 years, we had Bismarck coming to power in Germany, and we had the Meiji Restoration in Japan. And if you think about what happened, you had 3 new countries suddenly deciding to join the Industrial Revolution. So we had a world where you had a quasi-infinite supply of manufactured products coming on stream, but there was a quasi-fixed supply of resources to fund that expansion. So what did it mean? We had a huge terms of trade shift in favour of the resource producers. If we look at the GDP numbers per capita in 1900, the 3 richest countries in the world on a per capita basis were Australia, Canada and Argentina. And what this chart on the left-hand side shows is that terms of trade in action. So the blue line is basically the ratio of industrial commodity prices to CPI, and the red line is the ratio of soft commodity prices, grains and things, red CPI. And you could see that basically from the mid-1800s all the way through to the First World War, it was an upward sloping line. Now we had another temporary blip up, especially on the grains in the time of the Second World War, but fundamentally for the last 50 or 60 years it's been a pretty bad time to be a farmer or to be a miner. And obviously that's starting to change, but you can see the blip up we've seen in the last 5-10 years. It's quite small in the historical perspective. If we look at employment shares, that's on the right-hand side, what you can see is that America in 1867 had 8% of its workforce employed in manufacturing. And it went all the way up to 30% over the course of the next 3 or 4 decades. Japan was an even more agrarian society at the time of Meiji. We don't have employment data that I've seen for the first couple of decades after Meiji, but you can see that coming into the turn of the century, we probably had about 15-16% in manufacturing, and again, that peaked all the way at 30 around about 1970. If we were to run similar numbers for Singapore or for Taiwan or for Korea, you'd seen the same sort of slope in the last 40, 50 years. And interestingly enough, you see China and India. Now, the little red spike in China is quite fun, although it wasn't fun at the time. This is the Great Leap Forward. And this is when Mao Zedong decided that all farmers should stop being farmers, should melt down their pots and pans and become steel smelters. It didn't last very long. I don't have the data for Russia, but I suspect we'd see a similar blip with Stalin. You know, our Russian expert, I'm sure, can give me the data later. I'd also caution that we don't really have good manufacturing data for China and India, so I've used to proxy this by secondary activity, but that will include construction, that will include various other manufacturing related industries. But I think the trend is very clear, and what it's showing is that in China, we've done a fair bit of that trade, and the rebalancing of the economy, it probably is not going to be China having even greater shares of employment in manufacturing, it's going to be moving up the value-added chain in manufacturing. So if we think about when, and I was growing up as a kid in the UK, I'm not going to tell you when, but Datsuns were nasty little cars. 10 years ago, if you told your wife or your husband you were going to buy a Kia, she'd probably laugh at you. They've all gone up the value-added chain pretty quickly. We all laugh when we watch the crash test dummy tests on YouTube of the Chinese cars, but I suspect the Geelys and Cherries are going to be semi-decent cars in the next few years. So it's a value-added chain. India we haven't even started, and that's because India has really failed both to have a meaningful agricultural revolution and land reform, and B, thanks to an inheritance of Fabian socialism, has really never put in the places, the pieces for a manufacturing revolution. But there's no reason why that can't change in the next few years. The point I'd make is, if we move on, that these trends have got a long way to go. They are multi-decade processes, but they're not smooth progressions. Nothing is linear. And I look at the oil price on the left-hand side as a good proxy for this, because you remember in my previous chart there was a nice, relatively smoothed upward sloping line for commodity prices. The oil price, and this is just the annual data, just shows you how volatile it was. This was a period of huge boom busts, and you can see that the red line is the oil price in today's money. So we've only really until in the 1970s aside, where there was a huge supply shock, we've only really seen one other period with these sorts of elevated resource prices, oil prices, and you can see it went from 20 to 100 and back to 20 3 or 4 times in the space of a couple of decades. I've just blown this up into the modern day. This is the Aussie dollar. Yeah, the Aussie dollar is great, but it's I wrote a piece a decade ago saying it was going to parity, but it doesn't mean it's going to stay at parity and be smooth. We could easily go into any sort of global slowdown. You can lose 30, 40 cents off this thing, just as we saw 2 years ago. So I think one has to be very careful about managing one's volatility in this sort of environment. As I said earlier also, it was a very deflationary environment. Now we have a complete lunatic in charge of the Fed at the moment, whose belief is that although the problem that we got into in the global economy was because we had too much debt, the solution is let's create even more debt. Money printing, according to Bernanke's view of the world, if he'd have been in charge in 1929 in the Federal Reserve, or if he'd have been in charge in 1989 in Japan, just by printing money, none of these problems would have ever occurred. I'm not sure I tend to agree with that thing, but unfortunately I'm not the guy, I'm not the guy in charge of the Fed, and he is at the moment. Reality is that although we had a very deflationary period in the late 1900s, it was actually a period of tremendous prosperity, because lower prices, and actually the Japanese have shown this, doesn't necessarily mean that living standards completely crater. So if you look on the left-hand side, this is basically just indexes of real income, and you can see the green line throughout that whole period, which is US real income, was growing on average 4.5% per annum, which was a phenomenal growth rate in a historical context. Growth beyond population growth historically before the Industrial Revolution was just unheard of. And you can see this is all the price indexes. You can see prices fell, and looking at producer prices as a proxy for manufactured goods prices, you can see the greatest deflation was in the equivalent today of TV sets and DVD players. Not such a bad thing. Yeah, a deflation, if it's a destructive 1930s deflation, you see the cratering of US real incomes from 29, that's very bad news. But again, look at Japan. Japan's the red line. Yeah, we've leveled off. But is it such a bad thing? You know, there's plenty of mistakes Japan has made, but I think even Governor Shirakawa keeps trying to tell to Ben Bernanke, printing money wasn't really the issue in Japan. It's a structural reform. Anyway, this is too sort of short term for this talk, but point is that, as I said, deflation is actually quite a natural phenomenon in a capitalist world. And I don't necessarily think we should try to fight it. I think we should fight deflationary impetuses as we had 2 years ago when the banking system looked like it was going to completely stop functioning. But that's a very different thing from saying, I want to keep money too easy because we've got falling prices. That was the mistake Greenspan made. That's the mistake I think that Bernanke is continuing with. Now, some of you may have read a few pieces going around the market and the academic circuit about how China is basically Japan 89 and is about to collapse. Jim Chanos, who's a very well-known hedge fund manager, has been one of the biggest proponents. Gordon Chang, as we know, wrote The Coming Collapse of China about a decade ago. There's no doubt about it, China in the last couple of years has cyclically overdone it. What I've got on the left-hand side is a chart of fixed investment rates to GDP. And again, look at America. In 1890, the investment rate peaked at 35% of GDP. Developing countries, where you're suddenly moving people from the farm into the factory, need to build a lot of stuff. No bad thing. You can see in Korea, in Japan, in the post-war period, we simply had 40% investment rates. Singapore, I think, was the only country before China a couple of years ago to knock in a 50% investment rate a few years back. Malaysia also hit just about 50. Now, when you get to 45, 50, the wheels do tend to fall off. And, you know, clearly they overdid it in these countries. And China looks like it has overdone it cyclically. And that's why I think a period of somewhat slower Chinese growth would be welcome for all of us, quite frankly. But if we look at capital stocks, which is basically the sum of all the roads and the bridges and the electricity grids that you put in place, China hasn't even started. The sort of views that people like Chanos put out are based on, I believe, 3-day trips to Beijing and Shanghai and extrapolating that to the whole country. You know, yeah, Beijing and Shanghai are sort of pretty nicely built out cities. The software maybe isn't quite there, but the hardware is pretty funky. Certainly it's easier to get a taxi in Shanghai than it is to get a taxi in Singapore. I almost missed this lecture, but that would be my public policy recommendation for Singapore. Get that one right. But I mean, if you look at the capital stock per capita, the blue line is China, the green boxes are India. They haven't even started. They are going to be building stuff and taking people out of the countryside into the cities, expanding those cities, expanding the urban conurbations for many, many years to come. I put China's development level at about Japan 1965 or US 1900. Now, you know, there may be some margin for error, but we're certainly not Japan 89. When Japan went bust in 89, every man, woman and child already had their own bullet train line. So just building another bullet train line alongside it had no real marginal impact. You build the first road to a village, it's very, very productivity enhancing. A lot of complaints about waste on the railways at the moment, but one of the reasons I believe that wages are rising in southern China, in Guangdong province, just across the border from Hong Kong, it's one of the reasons why our air is getting better, is we are seeing a certain degree of low-end deindustrialization in southern China. For a very simple reason, that the success China has had in opening up the inner provinces has meant that a migrant worker who 10 years ago would have had no choice but to go 3,000 miles south to Guangdong or Fujian now has the choice of moving 50 miles down the road to the local town and maybe paid 3/4 of what he would be in Guangdong, but he's much nearer to his family. You know, it's the spreading out of growth, and this has been an explicit policy of the Hu Jintao government. It's not perfect, but you've got to say that the Chinese government has got more right than wrong, at least from an economic perspective, over the course of the last 15, 20 years. Doesn't mean they're going to continue to get it right. That's not a question for today, but I would give them credit. And I think that this industrialization India's problem, as you can tell from my accent, I'm a Brit, so I don't want to be an apologist for British colonialism. I think we did a reasonable job in some places. I think Singapore must be very grateful that you weren't run by the Dutch, let alone the French. But, you know, giving the Indians democracy, unfortunately, was like giving crack cocaine to Marion Barry. It was not a very, very good idea. And, you know, I think shooting half the baboos would be a real start in India, because the private sector, if it were allowed to do these things, would do it in India. In fact, the private sector is probably more capable of doing it than the private sector in China in many respects. Unfortunately, they're allowed to do it at home, so they do it overseas. But these are political economy constraints, which, if removed, there's no reason why India can't follow the same trajectory. And indeed, in the last few years, it's a bit messy, but you could see the sort of the purple dash line. India has actually started to accelerate to investment rates approaching what we've seen in the other Asian tigers in the last 50 years. I want to look particularly about railways. I like railways. I would have a nice Hornby set when I was a kid, and I'd like to buy another one, but my wife won't let me have it in the house, unfortunately. Again, there's a lot of talk about China's building too many railways. Well, the black line is America. America got to 400,000 kilometers of rail by the time the end of the 19th century came. China and India are planning to get to 125,000 each by 2020. Is that enough? Did the US build too many? Maybe. But clearly, this build out of the railways is an early stage project. And railways, you know, if we're worried about environmental degradation, you'd much prefer people doing 200 to 500 kilometer journeys on a rail track, high-speed rail, than doing it on the shuttle. America's railway system has basically been allowed to degrade in the last 50 years or so. The one line I would ever take in America is if I fly out there now and I go to New York, I'll always get the train up to Boston because they have upgraded that one. It's a 3-hour journey, it's very comfortable, and you don't have to mess about with LaGuardia and Logan. Plus the fact you don't have to worry about clean underwear in terms of body searches and that sort of thing either. But that's an exception in America. You know, if Barack Obama had spent more money building high-speed rail networks along the main corridors on the west and the east coast instead of cash for clunkers, I think, again, the marginal return on fiscal expenditure would be a lot greater in America. The UK, the Brits, we haven't built a new railway line, apparently, apart from the Channel Tunnel line, since 1890. The Indians equally haven't built anything since the Brits leave, as far as I can see. There's just been woeful underinvestment in a technology which is clean, far safer, and far more efficient about moving people around. Now, again, people get het up on the shiny high-speed rail. This is not the be-all and end-all. And the right-hand chart shows you both passenger and freight usage rates. Now, you can see in Japan, it actually goes off the scale. But the Japanese are the most efficient in the world of moving people around by rail. That doesn't necessarily mean they make money on this, and I'm going to come to that in a second. But every single city you ever go to in Japan has a very well built out metro system. The bullet train lines between the different cities are excellent, and you can see that the systems basically carry everyone easy. You can see on the red line, though, they don't actually carry much freight. That's because Japan is, like the UK, it's got a big coastline, so it makes sense that you ship stuff by sea, not by rail. For big countries like China, like India, like America, you want to move passengers between short distances by rail. You want to build out local metro systems, which the Chinese are doing. The Indians are thinking of doing, and they're doing a bit in Delhi. And you want to build out, I think, most crucially, the freight network. Did everyone read about the 100-mile traffic jam from Beijing to Inner Mongolia the other week? Well, this is why the freight, the red line in China, completely overloaded already. So, to be very frank, government officials want to build high-speed passenger rail links because they cost a lot of money, and if it costs a lot of money in China, it means you can steal a lot of money on the back of it. One of the big corporate governance problems in China is that while the government has been talking for quite a while about building low-end housing, rebuilding the medical system, rebuilding the education system, the local cadres don't find it's in their own personal advantage to actually pay teachers and nurses to show up at school. They do find it's a lot of their advantage personally to basically build lots of shiny office blocks and integrated massage karaoke complexes. And then the spillover gets taken and is gambled away at the nice Singapore resorts that have opened, or Hong Kong property, these sorts of things. But the concept of rail makes a great deal of sense. And so I think, again, we have to be clear that we're in early stage of this build-up. But it doesn't necessarily mean you're going to make money out of it. Now, if you think about what I was saying about the late 1800s, huge growth in America, 4.5% real GDP growth, nothing we'd ever seen before. What happened if you bought the Union Pacific rail stock? You lost all your money. You know, bondholders, stockholders got wiped out time and time and time by the robber barons period. The only way you made money was twofold. The first is you bought the land or the property where the railway was going to go. And the second was you bought the companies who put stuff through the networks that other people had built. You didn't want to be the person that paid for the network. Think about in the current terms, the French taxpayers who basically funded Eurotunnel. Think about Level 3 and Global Crossing. I hope none of you own those at the top of the tech boom. They're not in business anymore. But the pipes that they laid, we all benefit from that. You know, a business like mine, I couldn't have run an independent consultancy on a global basis as efficiently and cheaply as I would have been able to 20 years ago, simply because I had to spend money physically faxing documents, printing them, going to the printers, sending them out by post. Click of a mouse now. So my pricing, the pricing has fallen. This has been a very deflationary environment thanks to a network that somebody else put in place. So be smart when you're looking at these investments. Don't necessarily basically buy the guy that's actually putting the capital up front to put the physical stuff in place. Now the charts here, I think, demonstrate this process. There's a wonderful book written in about 1940, 1935 by a fellow called Homer Hoyt. It's called 100 Years of Land Values in Chicago. And he went through and documented every single transaction that took place in that area. I'm going to leave you a little quiz here. In 1860, what do people think the population of Chicago was? Anyone got any ideas? A million?
No.
Okay. 50,000? Anyone? 50 going once? Going twice? Well, you were the nearest, but you were only out by a factor of 10. 4,600 people. What happened? The railways went to Chicago, people followed, population exploded. And this is what this left-hand chart, the blue is the Chicago population. And basically those are billions on the scale there, or millions on the scale there. The black line is just the correlation with, or the relationship with the national railway length that was built out, because that opened up the Midwest and finally opened up all the way to San Francisco and LA in probably about another 2 decades afterwards. And the red line was the property values. And you can see that it was actually a pretty good proxy for nominal GDP. But it was a pretty volatile ride. On the right-hand side, I've just tracked property prices versus stock prices. And again, for the first 20 or 30 years, you didn't want to be in the stocks. It was only really towards the turn of the 20th century when Roosevelt came along, put in some semblance of corporate governance. This is the first Roosevelt with the antitrust legislation that broke up the trusts of the robber barons, that actually capital markets started to be more efficient than buying the land. So again, be smart on the networks. It's a good trade, but be careful how you play it. Now, I mentioned before affordable housing, and I want to talk about this because I think in India and China's case, it's a supply dynamic, not a pricing dynamic that's really the problem with housing in these two places. What I've got on the right-hand side is Hong Kong and Singapore's build-out of HDB, of public housing, in Hong Kong's case, from the 60s onwards, because both in the 50s and 60s, both Hong Kong and Singapore were hit with the same thing. Massive migrant populations, slums, nowhere to put them, and the governments in both cases just decided that they had to cajole the private sector in conjunction with the public sector into building out this low-cost housing. As we see on the left-hand side, if we look at average property prices to household disposable income, China's off the scale. The Indian numbers is just for Bombay, and I quite frankly don't believe the number. I think India is probably much nearer to the China number as well. And it's not because, in aggregate, property is very expensive. It's a composition issue how you make this sort of judgment. So what you're doing is you're taking a disproportionate amount of luxury property that's being built, because again, the developers and the local government officials can steal more money or make more money, profits, by building luxury. And you're looking at the denominator as being the average income of the entire urban masses. So in a UK perspective, it would be like looking at Kensington and Chelsea prices relative to income in Newcastle. It doesn't really make a lot of sense. You need to basically start to build stuff for the migrant workers who are becoming full-time urban residents, for the young urban kids who are graduating, that they can actually get on the ladder. And this is where I think the governance issues are going to come through, because it's my understanding that the HDB has been working quite closely with the Chinese government about how to deliver this. But if China can get this right, if India can get this right, again, a low-end housing boom doesn't necessarily have to mean bubbly prices, but a low-end housing boom delivers huge consumption growth associated with that. If you want to rebalance the economies from investment to consumption, give people their own home, because they buy furniture, they buy TV sets, they go to the DIY stores. It's a real win-win situation. And as you can see in Hong Kong and Singapore, that construction boom was followed by an upgrade boom, because the first round of HDB, the first round of public housing, was pretty shoddy in both places. Kept going for 30, 40 years. Again, get this right, the juice can be there. One difference, though, between now and the 19th century, and this is where I'm going to get a bit more downbeat, is that the US did this actually with a relatively unmonetized system. We had no such thing as the Federal Reserve. And as a result, basically, a lot of the risk was taken by private capital, which, if things went wrong, private capital got wiped out. India is actually not dissimilar on that path. And that's not because the capital markets can't function, it's just that they're crowded out by the government sector, which is so inefficient in India. But we are starting to see the first signs of monetization really starting to kick through, and if India ever actually got its act together on the budget deficit, you could, I think, see a big monetization surge in the place. It would free up a lot of capital for the private sector. China has a very different issue. China is very, very monetized already, which means that when you do get even marginal slowdown, the pain that can cause in the banking sector and financial markets can be disproportionately high. Now, I'm not making a case that the Chinese banking system is about to go belly up, but any sort of slowdown is likely to catalyze a big NPL problem once again in China. The governor of the central bank, the People's Bank of China, last year reckoned that 30% of the money that China put into the system, that was $1.5 trillion in 2009, was, in his words, diverted for speculative purposes. That's $500 billion that's probably gone missing. A fair chunk of it, as I said, is showing up in Singapore property and Hong Kong property. Hong Kong, I calculate, we had 35% of GDP last year in unaccounted for capital inflow. This is basically the boys from Beijing coming across with the Filipino candy stripe bags full of yuan. And they love Singapore, by the way, because you got a $1,000 note. The yuan, there's a very good reason the maximum note is only 100 yuan. They want to make it difficult for you. Singapore there's an even bigger one, 1,000, isn't there, I think, in Singapore. Yeah, that's ludicrous. As soon as the euro introduced a bigger denomination note than the US had it, the money laundering note of choice, switched to euro. Kim Jong-il made a very, very direct anti-American slogan by saying we're going to use our reference currency as the euro instead of the dollar in 2002. So the issue is that the monetization is one crucial difference, and the monetization, I think, adds to volatility. It doesn't dampen volatility. And as you can see in the rest of the world at the moment, we are in still a deflationary environment. Despite the unprecedented amounts of money and credit that Ben is trying to put into the system and the ECB is putting into the system to keep your home country afloat and the Irish and everyone else, the souffle is deflating. The analogy I would leave you with on this is that we have a souffle and a bicycle pump. The bicycle pump is the central bankers. This souffle of debt, the shadow banking system is collapsing faster than we can put money into the system. On China and India, it's all on balance sheet. That's the good thing. We will know where to find it. The bad news is that, again, any sort of medium-term slowdown does cause damage in the banking system, but China can still grow through that. Let's assume that $500 billion is not coming back. That's about 10% of Chinese GDP, which is actually pretty small beer. Ireland, only last week, again found another 20% of GDP that had to be found to bail out the banks. Indonesia ended up paying 70% of GDP for its banks. So China at this stage, yeah, it can cause problems, but it's not going to be a big issue. But if this monetization is allowed to expand further to American levels, i.e. they don't get a grips on the credit, yeah, then we can have a more difficult discussion. And if you've got too much debt, how do you get rid of it? Well, traditionally, there's been about 5 ways. My own favourite is the one that the Brits did after the Napoleonic Wars. You can see from the black line that the UK national debt, which was just the government debt in those days, basically got to almost 300% of GDP. Put this into context, Japan's 200 today, Greece is what, 150, something like that? That's their numbers. Anyway, how did the Brits get out of the problems after the Napoleonic War? It was really easy. We invaded lots of countries and we stole their resources and we used that to pay back their domestic bondholders. Great. The problem was everybody else thought that was a good idea as well, and it got a bit hairy afterwards. But it did work for the Brits. Basically, if we're assuming that we're not going to be doing the invasion route, the second thing you can do is you can ask people to pay the money back. Democracies don't like asking people to actually take responsibility for the decisions they've made. The US tried it in the 30s. It was not a good sociological experiment. Hong Kong did it. Hong Kong, with a fixed exchange rate regime, did a massive deflation from 1997 to 2003. Property prices fell 70%. We had big rise in unemployment, but Hong Kong is unique. It has the most flexible factor markets in the world. Along with Singapore, it's the most open economy in the world. External demand was actually doing pretty well. And the most important thing is Hong Kong is not a democracy. The problem I see in Europe, which is trying many of the same sort of deflationary things in a fixed exchange rate regime, is that it doesn't really matter in the end what Brussels or Frankfurt decide. These decisions will be taken on the streets. And I would leave you with a thought that Sweden, Denmark and the Netherlands, which are 3 traditionally the most tolerant countries in the world, all have avowedly anti-immigrant, anti-Islamic parties as part of the coalition now. The mood in Europe is getting very, very angry. The mood in America is getting angry, but the difference is in America, people are on the streets through the Tea Party complaining about too much government. In Europe, they're on the streets complaining about not enough government. The French rioting because they're going to have to retire at 62. Europe hasn't even started to get real, unfortunately. Anyway, we can look at that another way, but if we assume they're not going to be paying back, what's going to happen? We're going to get a default of some sort. And quite frankly, the quicker we get a bond restructuring, the better. But you can default in about 3 ways. The first is you can just say, I'm not paying back. That's what the Argentinians do every 10 years or so. The second is you can do what Robert Mugabe did, or Germany did under Weimar. You can hyperinflate. That gets rid of the debt really quickly, but has some rather negative social connotations. And the third thing is you can stealth inflate, which is, I think, what we're going for, which is basically, as Keynes said, you euthanize the rentier. And there's a very good reason why gold has been going up for the last decade. It's because people have clicked that fiat money is being debased. This debasement of debt is the root. Now, this is a nice 700-year chart just showing you the relationship between inflation and gold. I've got no view as to whether gold's probably overshot near term, but the reality is that if you're going to have governments going for this inflation route, whether or not they're successful, something has to give. In Asia, I think it's going to be Asian property. If you think about our property markets out here, we've basically got a level of interest rates we're inheriting from the West which is completely inappropriate. We've got households, with the exception of the Koreans and the Malaysians, who are actually undergeared. Most people have either paid down debt since 97, or in the case of the Chinese, the Indonesians, the Indians are just getting their debt for the first time. It's a hard asset. I think gold, though, you have to be very careful, because it not only matters what you own, but where you own it and what passport you carry. The Americans, as some of you may be sadly aware of, already tax income on a global basis. I think it's inconceivable that the Europeans won't try the same trick in the next few years. So, we all need to get different passports as Europeans as well at some stage. Or pay the tax. Or just stop working. The second thing is that gold has been confiscated many, many times in history. In 1934, when the second Roosevelt signed the Gold Act, there was a 50% devaluation of gold against the dollar. Well, 50% devaluation of dollar against gold, which was one of the things that basically started the money printing that was attempted. But at the same time, they signed into law that you had to surrender your gold at the new price. Kim Jong-il tried this one with the currency swap a few weeks ago, if you remember. And ultimately, if you didn't surrender your gold, any time in the next unlimited period you opened your safe, they had the right to have a federal agent there to look at your safe, and if you had gold in there that you didn't declare, it was a federal offence. Nixon did pretty much the same thing in 1973. I don't know if some of you saw this in the press. Hong Kong has recently moved its gold depository from downtown to near the airport at Kai Tak, and they found in an audit that there were 60,000 bars of fake gold in there. What had happened? Basically, tungsten is basically got the same sort of density as gold, so somebody had hollowed out the gold and filled it with tungsten. And actually, the most likely suspect is not China, going back to my point about faking gold, it's actually America. If this conspiracy theories are to be believed, the Nixon government, when it basically went off gold, at the same time sold a whole chunk of its false gold reserves to everybody else in the world. They didn't call him Tricky Dicky for nothing. I don't want to get too far off here, but the point is that people have throughout history had very safe assets that they thought were safe taken away from them, and especially when things get hairy. Now, this is one of the reasons, again, I'm very bullish on Hong Kong and Singapore. Throughout the last couple of hundred years of the British Empire, there was only one place in the empire that didn't suspend gold convertibility ever. That was Hong Kong. Why was that? Well, Hong Kong was, in effect, the classic laundering centre for the British Empire. Our colony was founded on basically drug smuggling and currency exchange, with a bit of gunboat diplomacy thrown in there. It's inconceivable to me that the Chinese Empire will view it any differently, because it is the laundering centre for the Chinese Empire. Why do Russians buy nice properties and Saudi Arabians buy nice properties in London? Because they trust the legal system there and they don't trust their own system. Well, that's why Chinese are buying properties in Hong Kong for cash. 35% of our property market turnover in recent times has been mainland cash buyers. Hong Kong and Singapore also have basically long-standing paper gold accounts, which you can just run through any bank account. So again, the public outcry, if Hong Kong and Singapore were to try an abrogation, would be absolutely immense. The other thing is, of course, governments in both places are in very good shape, so they don't need to do these sorts of things. And finally, I think what's going to happen is that because of the higher taxes, slower growth, regulatory malaise that's happening in the West, you're going to see more and more people coming to this part of the world to live, to set up businesses, and there's really only two sensible cities where you can run a business, an international business, and that remains Hong Kong and Singapore. And if Shanghai and Beijing get it right over time, Jakarta gets it right, that means the whole region is doing well. It's not a zero-sum game. So, to me, keeping your assets in this part of the world is very sensible, and clearly that's a policy that both governments in Hong Kong and Singapore are doing their very most to encourage. This is the stealth inflation. I've got two more charts and then I'm going to finish. The first on the left-hand side is bond yields. Now you can see an interesting spread between the blue line, which is the French 10-year yield. This is going back to the 1700s. And the black line, which is the British 10-year, or the British consul. Why was that? Well, again, if we look at European history, if we go back to about 1600 or 1550s, the French economy was actually the biggest in Europe. The Dutch and the British economies combined were bigger, and around about the late 1600s, we had probably the finest M&A deal in all history. We had the Dutch and the British thrones being unified under William of Orange, William of Mary, and you bolted on the nascent English industrial power with the Dutch financial system, which was the most sophisticated on the continent. The second thing that happened about that time was that the French kings started defaulting more regularly. Ironically, it was a Scotsman that really caused the damage, a guy called John Law, who was let loose on the French monetary system and basically collapsed it. But what it meant was that the British kings, who'd never really defaulted over time, basically found that they could finance their wars at a much cheaper rate, finance their industrialization at a much cheaper rate. And the UK was also very long coal, which was very useful in terms of the Industrial Revolution. Now, the Brits did actually default on their debt quite regularly, but we did it in a subtle way. We did it by selling honours. So the first parliament in the UK was under Edward I, about 1300 or so, the model parliament. And that was basically a reaction to him not being able to pay money back to the barons who'd funded his campaigns, so he gave them representation. You know, giving people a lordship or a dukeship or an earl or a slug of land is a very good way to pay off your debts. So you can see, as I said, this default premium is very interesting. But if we took to the right-hand side, this is where the euthanasia of the rentier comes in. What you can see is that there's 4 periods in the last 150 years where American yields have been sharply negative for an extended period of time. First is after the Civil War. The second is after the First World War. The third is after the Second World War. And then we had 73, the major inflation. And I think we're going there again. Now, people will say, well, surely US treasuries are going to sell off and, they print money, then there's going to be a run on the bonds. Well, that's assuming people have free choice. I think capital controls are coming back. There's a lot of talk about capital controls going on in Asia to stop money coming in. Capital controls are going to have to go on in Europe, going to have to go on in America to stop people from taking money out. And again, this period from 45 to 60 is very, very important historically. This was a period called Regulation Q, which said that the bond yields are not allowed to go above 2.5% per annum. So people were expropriated. You can steal people's money in many, many ways. That's what I would warn you. Finally, just to really cheer you up, I've talked mainly about economics so far, but we have to understand about the political consequences of these sorts of shifts. If we look at the late 1800s, as I said at the outset, this was a huge resource scramble. And when lots of countries start scrambling for resources, they soon bump up against each other's interests. The map on the left, I don't know if any of you have seen this before. It's a seriously scary map which has suddenly come into public consciousness much more because the Chinese have, for the first time, actually explicitly said that their whole interest is the South China Sea. It's a nice lolling tongue. Now, the justification China uses is, we found a bit of Han Dynasty pottery, so it shows this was an inalienable part of Chinese territory for the last 1,500 years or whatever. Yeah, right, whatever. On that basis, China is part of Mongolia. I've tried arguing that one with guys in the mainland, and they tend to have a sense of humour failure when you push that one through. Yeah, reality is that these claims are entirely spurious because they're all about oil and gas, which is the shaded areas. If we go back to Meiji Restoration, there was a country talking about peaceful rising. It was called Japan. And Japan peaceful rise in the first decade was all about trying to buy resources. The Japanese private companies went to Manchuria, went to Korea. They tried to buy concessions. The problem was they ran up against the Russians and the Germans and the Brits, who were not only trying to buy the things but to steal the things. And you had sort of lots of proxy skirmishes from the 1890s onwards, and it all really kicked off in 1902. In 1902, the Brits once again changed sides and basically took ourselves out of an alliance with the Russians and joined an alliance with the Japanese. And 2 years later, basically the Japanese thought that's a good enough signal and we'll attack the Russian fleet. And this was the first time that an Asian nation in modern history had basically whipped the arse of a Westerner. The Japanese actually fought on the side of the Allies in the First World War, and then were basically stitched up, as they saw it, at the Treaty of Versailles in 1919. Yes, they were actually given Germany's concessions in China, so that didn't please the Chinese very much, but China was so weak at that stage it couldn't do much about it. But the West basically refused to countenance a declaration of racial neutrality, in that Japan proposed that the new League of Nations should respect people irrespective of their race, of their colour, of their creed. And the Westerners decided that was one step too far. So Japan basically didn't get everything it wanted in terms of territory post the settlement. It certainly was still felt it was being treated as second-class citizenship, and we all know how that one ended in terms of the Greater East Asian Co-Prosperity Sphere. And actually, if you're ever in Tokyo, you should go and visit the Yasukuni Shrine. Not the shrine itself the shrine's actually very nice. We have to remember that the war criminals actually were only entombed there, or the people that are perceived as war criminals by the West anyway, were only entombed there about 20 years ago. It was a deliberately provocative act by a right-wing Japanese government to put them there. But the interesting one to go to is the museum, the privately run museum on the site. I implore everyone, if they're ever in Tokyo, to go and see this, because it is a wonderful example of revisionist history in process. And that feeds into many of the problems and distrust that we have in the region today. There is no such thing as Asia. I'm sure if the Dean were here, he'd talk about Asia rising and the like. But the reality is, Asia is an artificial construct. You guys all hate each other. We all hate each other in Europe. The nation state has not died. And the reality is that Asia is a very disparate region. All has its own interests. And let's take what kicked off in the Diaoyu Senkaku Islands the other week. That's the top map. And you can see that the Senkaku Diaoyu are basically equidistant between Taiwan and between Okinawa. So the Japanese will say it's ours, the Taiwanese say it's ours, the Chinese say Taiwan is ours, and therefore the Diaoyu are ours. Now, who cares? Well, it's because you've got fishing rights, it's got oil and all that sort of stuff up there. Japan has been its own worst enemy in many respects, because unlike the Germans, who've spent 60 years apologising to the rest of Europe and paying a lot of money to pay away that guilt, the Japanese just decided the money route would be the way to go, and they haven't really done very much in terms of making a real amends. And actually, I think that suits the Koreans and the Chinese, because it gives them a huge stick to continue to beat the Japanese with. So it's completely self-destructive. When it comes to Southeast Asia, China traditionally doesn't have the same animosities, with the exception of Vietnam. I was in Hue about 2 years ago. It's basically the site of their version of the Forbidden City, although it was levelled, unfortunately. But it's a very interesting historical site to go around. I was being taken around by this wiry ex-Viet Cong guy, who is hard as nails. I wouldn't have wanted to sort of try and go 3 rounds with him. He'd have taken me out just like that. But I was asking him about Vietnam's view of outsiders, because obviously it's a country that's had a lot of people going in. And I think one of the things you notice if you go to Vietnam these days is if you're an American, you actually get a very warm welcome. I go there and they say, "Where are you from?" And I say, I'm an Englishman, and they look quite disappointed. If I was a Frenchman, they'd probably spit on me, but that's a different issue. But what they say, basically, this guy said to me, "Look, this is how it works." He says, "The Americans, they were there for about a decade or so. We beat them anyway, so no hard feelings, and let's all be pals now." The French, they were there for about 100 years, and they left us some nice baguettes and pâté de foie gras, but fundamentally, they didn't really leave too much there, and we just don't care about them very much. But you have to understand the Chinese. They were basically in our country for 1,000 years, and we hate them. And that, I think, is behind a lot of the recent moves we've had. China seems to have been abandoning its hide your claws, bide your time type of doctrine and becoming a lot more assertive. That, in turn, has freaked many of the other countries in the region. And that's why Hillary, I think, was invited by the Vietnamese to go to Hanoi a few months ago to basically counter the Chinese claims. Now, I don't know how this is going to play through. Hopefully we know enough from history that it's a big enough world that we can all share and work together. But I think it's very important that ASEAN starts to move much more as a bloc. I think having ASEAN as a cohesive unit which can try and negotiate with China, try and come to accommodation, is much better than leaving the Chinese to try and pick off the countries one by one. Because fundamentally, China is short of these resources. It's short agriculture, it's short water. India has actually got a much better endowment than China has in many respects. Peaceful rising can happen. I hope it does. As an insurance, I think you should probably be long military contractors. There's some pretty good Singaporean ones you can buy on the stock exchange. But to sum up, the economic trends that have been set in place, we're still pretty early stage. Asia rising, yeah, the region's got a long way to go. We've come a long way in the past 50 years, and with good governance and with wise international relationships, there's no reason why we can't have another half a century of very great prosperity, pull even more millions out of poverty in this part of the world. But it's by no means set in stone, and if we don't understand the history lessons, we do risk repeat of a far less benign outcome. Thank you.
Thank you, Simon, for that historical tour de force. That was certainly very informative and very entertaining. We have time for question and answers. What I'd like to ask is if people want to ask a question, come up to the mic if you can, or speak very loudly from your seat. Identify yourselves, your institutional affiliation, and then ask a short, sharp, and succinct question. Maybe I'll start as the chair's prerogative. What do you see, Simon, in a nutshell, as the main challenges confronting Asia? What could go wrong?
As a Brit, I am a Eurosceptic, but I'm a skeptic of the Euro. I'm not a skeptic of the European Union. And I think the European Union, as a free trade movement of people, movement of capital union, has been tremendously important in helping diminish many of the problems that basically polluted the Western environment for 4 or 5 centuries. And unfortunately, I'm rather scared that the euro, as an artificial construct, has the ability to start to blow some of these things away again. But I don't think anyone really thinks that we're going to start to see conflict between the major powers in Europe anytime soon. So these moves towards East Asian communities and dialogue sessions, yeah, not a great deal seems to get accomplished, but actually sitting down in a room and talking to your counterparts, it's a very important part of diplomacy. And I think ASEAN especially, these small countries, with Indonesia feeling more confident in itself, if Indonesia is willing to basically take more of a lead, work with the other countries, and obviously you've got the Thais, you've got the Malays who've got their own internal problems at the moment. There's no reason why you can't build an equivalent of the European Union in this part of the world. At least in the ASEAN sphere, I think it has to be joining together, trying to create regional diplomacy and the like. Am I optimistic that's going to happen? It's not been something ASEAN's been particularly great at so far.
So your worry essentially is international conflict or regional conflict over resources?
I think there are risks. I wouldn't know how to probability weight them, but as we've seen with the Japanese standoff in the last few weeks, people are quite trigger happy.
Please.
Well, I'm Thomas Rowe, who's the European Union Fellow here. I'm not going to talk about European Union, because the contradiction in your Euroscepticism vis-à-vis the proposal that Asia should have a European Union was interesting. But my question to you is because of your comments on currencies and gold. Look at the US dollar. Look at US private debt, US deficits, US debt. Look at I saw a very interesting chart in The Economist a couple of weeks ago. The US has almost zero export cover in terms of its foreign exchange, if you exclude the pieces of paper they print. Look at the financial crisis, which was based in criminal misregulation of the housing market.
Sure.
Is not the US the big problem out there, not the Chinese renminbi?
On currency particularly, I'm a Eurosceptic with a small e. I don't like the euro as a construct. European Union I'm a fan of, and that's what I think ASEAN should move towards. On currencies themselves, fiat currencies, it's like 2 o'clock in the morning at the disco at the moment. There aren't any good-looking ones left at this stage. America still has inordinate privilege, though, in that it is the reserve currency by default or by design. Can the euro become the world reserve currency? Yeah, I think if you reject the people that shouldn't be in the euro in the first instance and have it with a sensible union, but I don't think that's going to happen anytime soon. Can the Chinese RMB become a reserve currency? It's not convertible. And it's not going to be convertible anytime in the next 20 years, simply because the Chinese government know that their own people would steal even more money if they took it out. And I've been told that by people at the PBOC. So the Americans are going to get away with a lot more. Are the Americans being completely reckless and saying the dollar's your problem? Absolutely. Are the Chinese being reckless and saying the RMB is your problem? Well, they are. Dollar RMB, though, is not the important cross. It's the fact that we're not allowing currencies in general to float, and it's boxing in many of the smaller Asian countries. The euro system, honestly, it's great for Germany in terms of they are hugely competitive. But if you decompose the real exchange rate of the euro into Germany and non-Germany euro, or you look at the spread between current account deficits and the huge surplus the German has, it just makes no sense. And as I said, if you fix your exchange rate earlier, every other factor has to adjust around that, which means huge deflation in much of the Eurozone. So I think there is a big role for currency coordination, but Asia hasn't junked mercantilism. The US hasn't junked its addiction to debt. And there's a lot of risks out there in terms of we've been very lucky not having the protectionist backlash so far. We could be seeing one.
At 2 o'clock in the morning, either you go home alone or you sleep with a dog.
And the dog is gold. Or the Sing dollar, maybe. Astrid.
Astrid Tunis, Lee Kuan Yew School of Public Policy. I think at the end of your presentation, Simon, you mainly kind of underlined China as where the threat may be coming from and not much about India itself. Would you argue that India, 21st century, like US 19th century, having a lot of resources, therefore did not feel that pressure to be so aggressive? Because US, you might argue, in the 19th century was forced, didn't really go aggressively, even its imperial venture was short and limited. Would you make the same argument about India today? And is there anything in the India-China nexus that may be dangerous given the economic trajectories of both countries? Thank you.
Yeah, I mean, I think I implied that, but thank you for asking me to flesh it out. Obviously, the Americans had one colony in Asia, which you know too well. Did a very fine job there. It's not easy to see. This is the string of pearls, which is the naval bases that China has been establishing surrounding India. And this is India's fault, because India has had shitty relationships with all of its South Asian neighbours for years. You know, they don't get on with the Bangladeshis, the Pakistanis, the Sri Lankans. And so, what do they expect? I think the second flashpoint is water. The Himalayan glaciers are melting. This is why the issues of the Kashmir Valley, Andhra Pradesh are so important. There's also a Dalai Lama element in there, which I'll talk about in a second. But the glaciers are melting far faster on the Indian side, which is causing, that's why we've had the big floods in Pakistan recently. And there's droughts on the Chinese side. China's real problem is a shortage of water in the end. Has it gone down? Sorry. Okay, better? Thank you. The Dalai Lama is an interesting one, because the Dalai Lama has said that he probably won't be reincarnated in China this time around, or in Tibet this time. And he's talking probably about a place called Taiwan, which is what China calls South Tibet, and what India calls Arunachal Pradesh. So, you know, there's plenty of issues here. China views rightly Tibet and Xinjiang, irrespective of their realistic claims there, as the equivalent that the Soviet Union would look at Ukraine or Georgia. And again, when the Americans were pushing NATO to expand to NATO into those two countries, that was the straw that broke the Russian back. Because China's never been invaded from the east or from the south. It's only ever been invaded fully from the north and the west. And so this is where those frontier clashes are. It's one is religious hegemony and total hegemony over Tibet. Secondly, water. And third, about sea lanes and the like. But India, as I said earlier in the talk, if India ever really had a proper agricultural revolution, if India could actually get its act together in building the infrastructure, it's much more like America. It really could take off. So let's hope the baboos are going to change. Huh?
My name is Venkataraman Sridhar. I work for a private trading company here in Singapore. My question is there enough intelligent dialogue going on among nations to solve the economic problems? And whether there's a system in place at all for such intelligent dialogue to take place, considering the various issues we have, like climate change, where there's a lot of disagreement? Thank you.
Well, as you can tell, I'm not a diplomat. And so I'm probably the wrong person to ask that question. I think we've got lots of talking shops, and talking shops, apart from being good for the conference business and the hotel industry, it's good when people get together. But I do think that when you have very difficult economic conditions back at home, people tend to go back to their local electorates and turn in on themselves. So it does concern me that you know, when times are bad, that you get less international cooperation. But to be very fair, one of the big positives in the last 2 years has actually been the lack of protectionism. The continuation of dialogue. Let's hope they can get to the right answers. But I have to say, I'm actually more bullish from an economic perspective that the Chinese will come to the right decisions than the Americans or the Europeans will.
Any other questions? Okay, we've got.
My name is Brian. I teach in a local school. My question is with regards to Myanmar. I'm just curious as to how important a trigger point Myanmar is in the India-China relationship, and also what you perceive to be the role the United States has to play in the region, and how important it is. You spoke about Vietnam welcoming Clinton to Hanoi. So, thinking geopolitically, what are your thoughts on that, please?
Well, Myanmar I would probably lump in with the Bangladeshis, Pakistan part I was talking about. It's a place where India should traditionally have had much better relationships, but for various reasons they've mishandled that relationship. And the Chinese have moved in and are using it as or looking to use it as an access to the Andaman Sea. If you remember when Thaksin was in ascendance, he was also talking about reviving the idea of a canal through the thin part of Thailand, along with the Chinese to give them the access. So China clearly wants that access from Yunnan across through the Mekong. And, one of the ball cases about, where Chinese investment is being welcomed is in that greater Mekong area. It's been seen as pretty good news for places like Laos, for Cambodia. As I said, the Vietnamese have a more prickly relationship. So I think, India and China will have issues in terms of the influence in Myanmar, and let's hope things get better there. I think in terms of the US role in the region, the US has, I think, been a pretty benign hegemon by global standards, historical standards. People might not agree with that, but they have kept the peace in this part of the world by their presence over the last 50 years. I think the sinking of the Cheonan, the North Korean allegedly torpedoing the South Korean boat, really refocused minds in both South Korea and in Japan as to who the main relationship. Lee Kuan Yew himself has said on a number of occasions that he views the American engagement in the region as being very important. And I think America being distracted at home does pose issues, which is why I was gratified that Clinton did come out here so quickly after the Chinese made what I do think is a very provocative move forward. It did upset a lot of people in the region. So I'm a great believer in counterbalancing, the realpolitik school. Obviously lots of people would disagree with me on that, but I think if I had to choose between America disengaging and letting the region get on with it, or the Americans sticking around, I choose the second one.
Thank you very much for a very interesting talk. My question to you is about the big debt that the US have. The Chinese central banks already come out to say that they hate the Americans for printing so much money, and you gave a few scenarios of what would happen. Assuming that they inflate out their problem, how do you see the worldwide economic scenario play out?
If you owe the bank $100, you've got a problem. If you owe the bank $1 million, it's really the bank's problem, and China's the bank here. So America is basically saying to the Chinese, dollar's your problem. And I think Chinese are starting to get there, and that's why they've been trying so forcefully to actually turn those potentially worthless chits into hard assets by buying resources and the like. The problem is that because there's such a lack of transparency as what is private investment in China and what is the state, that makes countries understandably nervous about receiving that investment. And Chinese didn't do themselves much favors a couple of years ago when they knocked back the Huaiyan Coca-Cola deal, which was a fruit juice manufacturer, and it was knocked back on strategic purposes. Now, there's only one other country I know that's stopped people buying a fruit juice manufacturer on strategic purposes, and that was France, with Danone and Orangina a few years back.
That was because of the yogurt, not the juice.
But the reality is China shot itself in the foot by doing that. Now, China is having much more success in Africa, in some of these places in Southeast Asia I talked about, but the places it really wants to buy those assets, be it Australia, Canada, America, it's finding Communist Party is going to have to become a lot more transparent and clean up its act if it's going to be able to put these things into hard assets. The other thing China wants is, of course, defense technology, and again, the Americans don't particularly want to sell them that. So I think China is going to have to take a hit. But actually, if you talk to more sensible people at the PBOC, and other officials in China, they realize that basically they've used the cheap currency policy as basically a huge export subsidy over the years. So they've now got close on $3 trillion. So let's say dollar yuan is going to go down 30% in the next 5 years. That's not a forecast, that's just a working assumption. So they're going to lose $1 trillion worth of their treasuries, mark to market. How much extra income has been generated in China by all of the manufacturing jobs that have been created over that period? It's a good trade. You probably don't want to be in charge of the central bank the day you actually have to realise that loss. You know, our friends across the border in Malaysia found that when Soros took sterling out of the ERM. But fundamentally, I don't think China's had a bad deal out of this one. And quite frankly, China's not doing anything different to the rest of the region, what it did for 50 years. You know, they're all currency manipulators. The biggest currency manipulators at the moment are the Koreans. You know, they are possibly the worst country to be hosting G20 at this time, because the intervention on the yuan makes the Chinese look like a little cakewalk. So I think it's a problem, but fundamentally Asia has to get itself off the mercantilist drug at some stage, move on, take the hit on the treasuries. You know, that should not be a binding constraint, because if they really want to have appropriate monetary policies for their own domestic economies, they can't be inheriting US and European interest rates. It just makes absolutely sense. That's a recipe for a rerun of 97 asset bubbles, and we all know how that one ended.
Middle there.
You referred to the governments in the region before as trigger happy, and there's been some talk about China buying up, for example, Japanese yen.
Can you introduce yourself? Sorry, can you introduce yourself?
Sorry. Yeah, my name is Ola. I'm a student here at the school. There's been some Economist wrote some articles about that. I was seeing the different countries here intervening in these other currencies in a big way in the near future. Is there going to be like a meltdown in the region?
If I was Japan, I would be buying the Korean won and the Taiwanese dollar like it's going out of business, because Japan has been absolutely killed. You know, Japanese exporters relative to Korean exporters or Taiwanese exporters or German exporters are really suffering. You know, we could see a major Japanese iconic firm going bust in the next 6 months. I think Mazda is the top of my list, because Ford has just announced it's going to take away its backing. You know, Mazda sells 70% of its cars from Japan. Takafutsu, which was the big finance company in Japan, went bust only a month ago. So, yeah, I do think that we're going to have, unless we can have a coordinated exit, and this is where China is so important. If the Chinese do allow more yuan flexibility, it doesn't necessarily have to mean a big revaluation. And if they importantly start to raise interest rates more to cool in their own property bubble, and maybe we saw the first step of that on Monday, that's why I'm a bit more optimistic that China at least is coming round to this view, then we can avoid this sort of thing. But if the Chinese are just going to, Chinese have actually depreciated their currency in the last 3 months. So everyone's looking at the dollar, but the Chinese have gone up less than everybody else in the region. So on a trade-by basis, it is a problem, and people are getting increasingly upset. You heard in the introduction, I sort of do work with central banks across the region. I can tell you that although everyone's very polite to each other in public, behind closed doors, there's a lot of quite tough talk and finger wagging going on.
Well,
what's your view about Japanese government debt?
can I just? I'm afraid I'm going to have to call it a night, because we have a class that's supposed to have started 5 minutes ago here. So if you can all join me in thanking Simon for a great talk.